The gradual phase-in of taxes on Social Security benefits can deliver some unexpected and unpleasant results if you fail to recognize that there is a danger zone you need to avoid. The calculation the IRS uses to determine how to tax Social Security income creates this zone where taxes on benefits can be significantly amplified. And if you fall into this danger zone, you could pay a much higher tax rate on some of your retirement income. And in this video, I want to talk about what you need to know about the taxes on Social Security benefits and how you can avoid the pitfall of paying way too much taxes on that income. But before we jump into that, I did want to share a bit of personal news with you. A few weeks ago, I made the decision to add a creative director to my team. Up until I made this hire, I was doing a lot of the creative work on my own and ultimately had to come to the realization that this was not a wise or efficient use of my time. So now I have someone in the background that handles just about everything besides the research and recording. And here's why that's important for you. Not only is this going to allow me the time to focus more on my core business and serve the needs of Carroll Advisory Group, but this will also allow me to create more content for you. So if you're new here, be sure to subscribe and hit that notifications bell so you won't miss any of my upcoming videos. So when we're talking about the danger zone in Social Security taxation, individuals fall into three basic categories. The first is where none of your Social Security benefit is taxable. The second category is where somewhere between 1 and 85% of your benefit is included in taxable income. And then there's the zone where 85% of your benefit is taxable. The danger zone exists in that second zone, and you can see that there's some overlap at the top end of that first zone and the bottom end of the third zone. In the first category, where none of your Social Security benefits are taxable, you have no real need to fear slipping into this danger zone unless you have other income that could push you into that second category. And on the other hand, if you're firmly in the third category, where 85% of your benefits are taxable, the only real choice you have is to somehow lower your reported income so that you qualify for the first or second category. And this may be unrealistic, as people who find themselves in that third category are usually there thanks to large incomes from pensions, required minimum distributions, or some other source. So sometimes there's not a whole lot that can be done. But if you find yourself in the top of the first category, anywhere in the second category, and the bottom of the third category, you may have more control over how much you pay in retirement taxes. I call this area the danger zone because this is where taxes can double on income. And for some, this danger zone of magnified taxes can easily be avoided with a strategic, well-thought-out retirement income plan. And this all starts with knowing your numbers. The first thing you need to be able to do is calculate your combined income. This is the number the Social Security Administration uses to determine how much of your benefit is taxable. It's often referred to as provisional income, but we'll use the specific term combined income since the Social Security Administration uses that term almost exclusively. This combined income can be roughly calculated as your adjusted gross income plus any tax-exempt interest, like interest from tax-free bonds, plus 50% of Social Security benefits. Once you've calculated your combined income, you simply apply it to the threshold tables to determine what percentage, if any, of your Social Security benefit will be included as taxable income. First, let's look at the combined income tables for a single person. If your total combined income is less than the base amount of $25,000, none of your Social Security benefits will be taxed. But if your combined income is between $25,000 and $34,000, up to 50% of your benefit may be taxed. And if your combined income is more than $34,000, up to 85% of your benefits may be taxed. Now, if you file a joint return and you and your spouse have a combined income that is less than the base amount of $32,000, none of your benefits will be taxable. If your total combined income is between $32,000 and $44,000, up to 50% of your benefit is taxable. And if your combined income is more than $44,000, up to 85% of your benefit may be taxable. Now, this system is a gradual phase-in of tax on Social Security benefits where, as income rises, more of your Social Security benefits are subject to taxation until eventually a maximum of 85% of all benefits are subject to taxation. And because of the way Social Security income phases into taxation through this formula, there is a danger zone where every dollar of increase in combined income pulls more Social Security into taxation. In this zone, the effective tax rate on the other income skyrockets. For example, if an individual is in the upper end of the danger zone and takes $1 from their IRA account, they'll not only have to pay tax on that $1, but also on 85 cents of their Social Security benefit. Effectively, because they took out $1, they had $1.85 added to their taxable income. Let me give you a real-world example of how this may work. Let's assume that a married couple, Wayne and Lisa, have the following retirement income streams. Wayne has a full retirement age Social Security benefit of $3,000. Lisa qualifies for the spousal benefit of $1,500. So collectively, they have $4,500 in monthly Social Security income. They also have a pension from Lisa's work, which is $1,500 per month, and then they take $2,000 per month in distributions from their retirement account. So using this income, we can quickly do a calculation and see that annually, this is $24,000 in IRA distributions, $18,000 in pension payments, and then $54,000 in Social Security benefits. Based on those income numbers, we can run this through a quick tax calculator and see that their taxable income is $41,450, and federal taxes owed for the year is $4,579. So they're paying an effective tax rate of about 11%. So let's change things up a little and assume that Wayne and Lisa wanted to take an extra $10,000 from their retirement account to go on a nice trip. So how would this change things? Well, you take the $54,000 from Social Security, the $18,000 from Lisa's pension, and then you'd have to include the additional $10,000, which would have to be added to the regular IRA distribution of $24,000. So in total, they had $34,000 in IRA distributions. So when you run all of that through the tax calculator, you get a taxable income of $59,950 and total tax owed of $6,800. Now, what's going on here? You only took out an extra $10,000 from your IRA, but your taxable income increased by $18,500, and your tax bill increased by a little bit more than $2,200. And that additional $2,200 was solely due to the extra $10,000 in IRA distributions. So while Wayne and Lisa paid 11% on the rest of their money, that distribution of $10,000 was taxed at an effective rate of 22%. That's double. What Wayne and Lisa experienced here was the Social Security tax danger zone. When $1 in taxable income increases your taxable income by more than $1. This may be avoidable. In many circumstances, there are opportunities for planning around this danger zone and avoid having more of your hard-earned money go to the IRS. If you still have some time before retirement, you may ought to consider using a Roth IRA. This is possibly one of the most valuable tools for planning around tax on Social Security because distributions from a Roth are not counted in the combined income formula. So if you think you may eventually be in this danger zone, consider building a pool of money in your Roth account. You may be able to contribute to a Roth IRA up to $6,000 per year, and that's $7,000 if you're over the age of 50. And check with your retirement plan at work as well. See if they offer a Roth option. Using a Roth 401k or 403b in 2021 at least will allow you to put in up to $19,500 per year, and that's $26,000 if you're over the age of 50. Or you may want to consider converting traditional IRAs to Roth IRAs. Now, there's certainly a lot to consider when you're doing that, but since the tax benefits could extend just beyond the tax-free nature of the Roth, that could turn out to be a winning move. Another strategy you may want to consider is just simply to organize your retirement income in a manner that would lead to more of your income coming from Social Security and less from sources that are 100% taxable. For example, if you plan to retire at 65, it may be most optimal to take your early years of retirement income from your retirement accounts while letting your Social Security benefit increase because, remember, only 1/2 of your Social Security benefit will count in the formula that determines the amount of that benefit that will be subject to taxes. There are certainly other strategies to consider, and like many of these that we've discussed, it often comes down to your individual and specific circumstances. The point of this video is not to tell you, don't spend your money or you'll have to pay taxes, but rather have a plan to spend the money you want to spend and reduce the taxes you pay in retirement. One thing is for sure, planning your retirement income stream is absolutely worth the effort. And if you want some help in planning your retirement income stream, I want to tell you about my Retirement Optimizer plan. This is not just a Social Security plan, but a roadmap of your retirement income. This is the big picture approach where we consider retirement assets, pensions, Social Security, and we plan how to coordinate it all to get the monthly income you need in the most efficient manner possible. And once we've determined the optimal sequence of distributions, we break this down on a year-by-year basis where you can clearly see where your income is coming from every year and how various changes can affect that income. Now, I don't mind putting it right out there in the open how much I charge for this. The fee for this service is $1,000, and I think it's well worth it. If you want to find out more, there's a link in the description where you can get started with a free 15-minute consultation to see if you're a good fit for this plan. You should know, though, that if you engage me and my team to do one of these plans, I will be switching hats from YouTuber, blogger guy to financial planner and offering this service through my registered investment advisor as a fiduciary. I look forward to talking to you soon. Thanks for watching.